The U.S. student loan system is undergoing a massive regulatory rewrite. A new law sets a firm deadline, altering repayment for federal borrowers, July 1st, 2026. That date creates a strict dividing line. The options to manage your debt today look entirely different from the ones you'll be left with after that cutoff. While the legislation has sparked plenty of partisan debate, we are strictly looking at the math. This is about your monthly cash flow. The choice right now is whether to make a deliberate plan for this transition or let the system make the choice for you. If you do nothing, you will automatically be dropped into a standard repayment plan, which strips away income-based protections and typically demands a much higher monthly payment. Depending on the specific type of loans you hold, you need a blueprint to navigate this shift before the deadline passes. Here is exactly what you need to evaluate. First, the current SAVE plan is being completely shut down. If you are one of 7 million borrowers currently enrolled in SAVE, you'll need a new home. The older income contingent repayment plan is also on the chopping block. Pay as you earn follows suit. Both PYE and ICR will be fully eliminated by July 1st, 2028. You can stay grandfathered into those older plans until 2028, but there is a major catch. If you take out a single new federal loan after July 1st, 2026, you will instantly forfeit access to them. When these legacy plans vanish, the government's new default setting takes over. It's called the Tiered Standard Repayment Plan. Think of this like a traditional mortgage. You are given a fixed repayment window between 10 and 25 years, with larger debt balances requiring longer terms. Under this tiered plan, your payment is fixed based strictly on your principal. If you lose your job or your wages drop, the monthly bill stays exactly the same. There is zero income-based flexibility. Waiting out the clock on older systems is no longer a viable financial strategy. You must pivot and plan for the new rules. Let's look at the first group, current SAVE enrollees waiting for the Department of Education to tell them what to do. If you wait for the transition to happen to you, your loans will default into that rigid standard repayment plan, meaning a sudden spike in your required monthly expenses. To avoid that, you have to actively choose the one remaining income-driven alternative, the new Repayment Assistance Plan, or RAP. This chart maps out exactly how RAP calculates your bill. Instead of a flat fee, RAP takes between 1 and 10% of your adjusted gross income, while enforcing a strict minimum payment floor of $10 a month, even for very low earners. Let's plug in a single borrower earning $50,000 a year. Under the old SAVE plan, their monthly payment sat around $110. Under RAP, that same earner will pay roughly $210 a month. There are distinct trade-offs here. While RAP forgives your unpaid interest every month so your balance doesn't snowball, the timeline to actually achieve loan forgiveness stretches out to a full 30 years. Even though your monthly bill will likely be higher than it was under SAVE, you still have to actively enroll in RAP if you want to keep any protection against sudden income drops. The stakes are significantly higher for a specific demographic, those holding Parent Plus loans. For these borrowers, missing the July 2026 cutoff triggers a complete lockout from the income-driven safety net. If you take out new funds or decide to consolidate these loans after that July deadline, you permanently lose access to any repayment plan based on your earnings.
Making matters worse, Parent Plus loans are explicitly barred from entering the new RAP program. That leaves you trapped in the inflexible tiered standard plan. Even if you retire and your income drops by half, your required monthly payment will not budge. There is a narrow window to prevent this. You must consolidate your Parent Plus loans before the July 1st deadline. Beating the clock and consolidating now allows you to legally preserve your access to the older income-based repayment system. If you hold Parent Plus debt, you cannot afford to wait. This deadline is the hard boundary between maintaining a manageable retirement budget and being forced into rigid, unavoidable debt payments. We also need to address the 10 million borrowers currently sitting in default. Right now, the Department of Education has placed an administrative pause on involuntary collections, but that pause is temporary. When it eventually lifts, the government will resume taking up to 15% of your disposable income through wage garnishment, along with seizing your tax refunds. The new legislation does provide a narrow exit ramp, offering a second chance loan rehabilitation program. If you proactively make voluntary payments under this new framework, you can permanently suspend those administrative wage garnishments.
This means you have to treat the current collection pause as a short grace period to arrange rehabilitation, not a permanent pardon for the debt. Finally, let's look at borrowers currently working toward public service loan forgiveness. Come July 2026, a new restriction takes effect, denying forgiveness to anyone whose public employer is deemed to have a substantial illegal purpose by the Education Secretary. Several major municipalities, including Chicago and San Francisco, have already launched lawsuits, arguing this clause could be used to exclude their city employees from the forgiveness program. Because of these impending rule changes, the federal processing queue is highly likely to experience massive application backlogs. If you are on the PSLF track, you need to submit your application the exact moment you hit your 120th qualifying payment. Do not delay. Filing early fixes your timestamp in the queue, protecting your timeline before these narrower, more restrictive definitions can be used to disqualify your public service. The reality of this overhaul is mathematically simple. The heavily subsidized legacy plans are disappearing, leaving you with only two destinations, RAP or the tiered standard plan. Your urgency depends on your specific risk. If you hold Parent Plus loans or are currently in default, you need to consolidate or start rehabilitation immediately. If you are a standard borrower coming off the SAVE plan, your task is to project your adjusted gross income so you know exactly what the new RAP formula will demand. The mandatory starting point for all of this math is the official loan simulator on studentaid.gov. You should never pay a third-party company to consolidate or evaluate your loans. The official simulator gives you the exact same calculations for free. Keep the July 1st, 2026 deadline on your calendar. The government has made it clear there are no extensions. Taking the time to structure your loans now is the only way to insulate your budget against permanent payment increases later. Log into your account, identify your exact loan types, run the simulator today, and file the necessary paperwork to protect your cash flow.